Today is the third anniversary of the flash crash where the stock market dropped as much as 1,000 points in just a matter of minutes, only to recover just as quickly. Joining me today is Otto from Knight Capital, who's going to talk to us about his experience on that day, as well as what procedures have been put in place since then. Thank you so much for joining me. It's a pleasure to see you again.
Thanks for having me back.
Absolutely. So what was your experience like on that day?
It was a pretty crazy day. May 6, 2010. It all started around 2:42. But really the movement was between 2:47 that afternoon and 3:07. So a lot of people went on break that day and came back in a lot of shock. So anyways, apparently the situation started with the S&P 500 minis. A mutual fund put in an erroneous order, and it sort of made a ripple effect that went market wide. Many of these S&P 500 stocks that were brand names were printing at a penny and at $100,000 in some cases. During that period of time. So the ripple effect, was across the entire market. Added to which, that day we were already down about 300 points, simply because the Eurozone debt crisis, little old Greece, was causing all sorts of havoc that day anyway. So the additional 600 plus points is really what we're talking about that occurred in that day during that 20-minute time frame. Here on the NYSE, we actually already had systems put in place for volatility. We had liquidity replenishing points. And based on the last sale of your stock would only move 25 cents, 50 cents, or a dollar off the last sale, and would go into what was called a slow market. So let's say, for example, if you had a $15 stock and your LRP was 50 cents, it would hit or take every offer or every bid down, up or down 50 cents, and you have a residual of the order. So let's say 1 million shares swept down, and you executed 250,000 shares, 750,000 shares would be left over. The human being standing there at the point, your designated market maker, would actually go in and make a decision. He would actually reflect a quote of what's going on, offer 750,000 shares and bid down lower, showing the entire world what's going to happen next. And in case of public interest not being there, that you'd be the proud owner of about 750,000 shares of that stock. So based on that one example, this type of situation was going on across the floor. A lot of people were down here. It wasn't one of these things like, oh my God, is this another 9/11 event? There wasn't this like pandemonium and chaos like that. In fact, a lot of people started talking to each other across the floor, and we sort of figured out that it was some sort of a system error that everyone was starting to react to. Now, on other market centers, all of a sudden, a lot of these chaotic prints were going on that were causing all this havoc in the market. So here, I'm proud to say that sounder minds prevailed. Having human beings down here did help to stabilize many of the stocks that were listed here. Consequently, many thousands of shares were traded that day and broken on other market centers. Here on the NYSE, we actually didn't have to break anything.
What procedures and protocols have been put in place since the flash crash to prevent something else like that from happening?
Well, the response was almost immediate. So it happened in May. In June, I believe, of the same year, they started putting circuit breakers in place and test piloting them on the S&P 500 stocks. Now, a lot of these were sort of mimicking what was already in place here on the NYSE. Along with the circuit breakers that have developed since then, there were also rules and regulations as far as breaking trades. Erroneous trade rules were put into place. So if it was obvious that the execution was well off the last sale or displaced, that those trades could be broken. Everything's evolved since then. We're 3 years later. Here on the floor of the NYSE, those LRPs don't exist anymore. We had volatility trading pauses for a while. Now we have limit up, limit down rules. So the same idea applies, except for now it's just bands that are in and around the last sale of the stock based upon the consolidated volume and the consolidated price over a 5-minute period. So they actually move up and down. So if all of a sudden there was a massive order to buy and sell, they couldn't trade outside those bands. And again, the human being would actually go in and have to react. If it actually wasn't cleared up after a 5-minute pause and went to a 10-minute pause, there's actually a governing body here on the NYSE that would actually get involved. And again, human beings getting involved in trading and doing the auctioning market, which is actually what we're best at doing down here.
And finally, obviously you can't talk about high-frequency trading and algorithmic trading, but since the flash crash, there have been some technical glitches, and then there was that AP Twitter hacking scandal that happened a couple weeks ago. What do you think we've learned since the flash crash, and how can we use that knowledge in the future?
I think technology is just moving along so rapidly that a lot of times you are going to have these setbacks. I think it's important for everybody to learn off the mistakes that we've made so we can adapt to them and put the proper rules and regulations in place to ensure that it doesn't happen again.